What if I told you Warren Buffett, the stock market guru, has billions invested in bonds? Stick around to find out why the Oracle of Omaha might be so heavy in bonds and how it could impact your investment strategy. Today we're diving deep into Warren Buffett's surprising love affair with bonds. That's right, the stock market legend has been loading up on treasury bills like they're going out of style. But why? And more importantly, what does it mean for you? Now, you might be wondering, why would one of the greatest stock investors of all time bother with bonds? Well, even Warren Buffett knows that bonds can be an important part of a well-balanced portfolio. In fact, in his 2012 letter to shareholders, he mentioned how Berkshire Hathaway was sitting on a huge pile of treasury bonds, $20 billion worth. He didn't make that move by accident. Buffett often uses bonds as a tool for security and liquidity. Now let's move on to a jaw-dropping fact. Buffett's Berkshire Hathaway, according to their second quarter report released back in August of 2024, now owns more U.S. Treasury bills than the Federal Reserve itself. We're talking a whopping $234.6 billion versus the Federal Reserve's $195.3 billion. That's billions with a B, folks. Now you might be thinking, bonds? Aren't those for retirees and risk-averse investors? Well, Buffett's recent moves are challenging that notion. This isn't particularly new because he mentioned in a CNBC interview in August of last year that Berkshire Hathaway had been scooping up T-bills to the tune of $10 billion every Monday. That the only decision left to make for next Monday was whether they were buying the 3-month bill or the 6-month bill. It's like he found the ultimate Black Friday deal, but instead of TVs, he's buying government debt. For each of these $10 billion purchases, Buffett stands to make an annualized profit of $500 million. That, in and of itself, is a staggering number when you think about the fact that what he is investing in is considered to be some of the least risky securities in investing. Most people consider cash in your hand to be the next least risky thing after T-bills that you can own. And yet Buffett is going to rake in billions this year in them. But here's where it gets really interesting. Buffett isn't just buying bonds, he's selling stocks. In fact, he recently cut Berkshire's stake in Apple, yes, that Apple, by nearly 50%. When the world's most famous value investor starts dumping stocks and buying bonds, it's time to sit up and take notice. It was also recently released that Buffett is cutting his stake in Bank of America. He's cut his ownership in the bank from 13% down to 10% at a rather interesting time. Many investors believe that the normalization of the yield curve will benefit banks. They traditionally borrow money through deposits at typically lower short-term interest rates and lend them out long-term, where the rates are typically higher. However, Buffett seems to think it's time to scale back his exposure to the financial sector. Pause for a moment and think, what would make you shift your investment strategy so dramatically? Drop your thoughts in the comments below. I'd love to hear what your take is on this. Here's what I think is going on, and it's just some simple math. Buffett has some cash to invest, and has for quite some time, well over a year. He is weighing all of the investments he is seeing for their risk and possible return. He looks at the T-bill market and says, for virtually no risk, I can get 5 to 5.5%. At least he could up until a month ago or so. Now he compares that to everything else available to him, and he weighs the risks with those options versus the difference between what he can get in a T-bill versus what he's going to get in these other riskier bets. If he thinks he spots something that could return, say, 7%, he has to weigh whether all of that additional risk is worth an additional 1.5%. Clearly, he's just not seeing any opportunities that are worth the increased risk right now. Now let's take a quick trip down memory lane. Back in 2008, during the financial crisis, Buffett made a similar move, and this is what's making a lot of folks a little nervous. He loaded up on corporate bonds when everyone else was panicking. The result? Berkshire made billions when the market recovered. Could history be repeating itself? But here's the million-dollar question. Why is Buffett so bullish on bonds right now? In his own words, we find them quite attractive. With short-term rates exceeding 5%, Berkshire's massive cash pile is now generating substantial returns. We're talking about potentially $12 billion in annual interest. That's not chump change, even for a billionaire. Here's a surprising tip from the Oracle himself. Quote, "The most important thing to do if you find yourself in a hole is stop digging," close quote. In the context of bonds, this means knowing when to cut your losses and when to double down. It's not just about buying bonds, it's about buying the right bonds at the right time. As a 30-plus year bond trader, I'd give you the same advice. Bonds aren't right for every situation, but there are times when they make a lot of sense. And Buffett seems to think this is one of those times. While many are throwing out the doom and gloom to get clicks to a lot of us, this looks like one of those instances when Buffett is buying bonds because they are the best option, not because the sky is falling. Similar to 2011. Did you know that Buffett used bonds to secure a massive stake in Bank of America back in 2011? He bought $5 billion worth of Bank of America preferred shares. Preferred stock acts a lot like bonds. They paid him a steady 6% annual dividend, and years later, he converted those into common stock, making billions more. If you're finding this deep dive into Buffett's bond strategy enlightening, do me a favor and hit that like button. It helps the algorithm gods smile upon us, and who knows, maybe Buffett himself will stumble upon our little corner of YouTube here and like it too. And while you're at it, why not subscribe? I promise you more bond insights that'll make your portfolio as happy as Buffett at a See's Candies factory. But let's not forget, Buffett isn't always right. He's made his fair share of mistakes, and he's the first to admit it. Remember his famous quote, rule number 1, never lose money. Rule number 2, never forget rule number 1. Well, even Buffett breaks his own rules sometimes. Now let's address some common misconceptions about Buffett's bond strategy. 1, Buffett is abandoning stocks completely. Not true. He's adjusting his portfolio, not overhauling it entirely. In cases like Apple and Bank of America, he's taking some well-earned profits. 2, bonds are only for conservative investors. Buffett's moves show that bonds can play a strategic role in any portfolio. Sometimes bonds are the best opportunity. Buffett seems to think so with T-bills. So if you're not looking at the bond market, you could be missing out. 3, high bond yields will last forever. Remember, the market is cyclical. What goes up must come down, eventually. With Jerome Powell and the Federal Reserve's commitment to lower rates over the next 18 to 24 months, Buffett may be forced to find some other outlet for this money. But for now, he's getting as much of it as he can. Perhaps you should too. For you younger investors out there, here's a Buffett-inspired tip. Start early and think long term. Even if you're not ready to go all in on bonds like Buffett, consider allocating a portion of your portfolio to them. It's all about balance and diversification. There's no reason you can't get in on some of these low-risk securities that are offering a really nice return for now. It doesn't mean you have to buy T-bills with this money to infinity and beyond. It means buying them now while yields are attractive. Perhaps bonds aren't currently on your radar, but you want to dive deeper into the world of bonds? Check out our Bond Basics playlist. It's packed with everything you need to know to start your bond investing journey. Investing is all about choices. Remember, Buffett's strategy isn't one size fits all. Always do your research and consider your personal financial situation. But one thing's for sure, if the Oracle of Omaha is betting big on bonds, it might be time for all of us to take a closer look at our fixed income strategies. And hey, if you enjoyed this deep dive into Buffett's bond strategy, smash that like button and subscribe for more insights that'll make your portfolio as robust as Buffett's. Otherwise, you can watch the video on the screen now that YouTube thinks you'll love. And remember, always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Please see the description for the full disclaimer.